AI valuation models for stocks. How AI determines a stock's true value. Understanding the true value of a stock has always been the cornerstone of successful investing. Traditional valuation methods, such as discounted cash flow analysis, and other fundamental metrics, have been used for decades to assess whether a stock is undervalued, fairly said, or over. While these approaches have their merits, they often struggle to account for complex patterns, changing market conditions, and massive volumes of data. That's where artificial intelligence, or AI, comes in. AI valuation models have revolutionized stock analysis by using advanced algorithms, machine learning, and big data analytics to determine a company's true value faster, more accurately, and with less human bias than ever before. In this video, we'll explore how AI valuation models work, the different techniques used, the types of data they rely on, and how you as an investor can leverage AI to make smarter, more informed investment decisions in the US stock market. AI valuation models start with data. Data is the fuel that powers AI, and these models require massive amounts of it to make accurate predictions. Traditional financial data includes income statements, balance sheets, cash flow statements, historical stock prices, trading volumes, and market capitalization. But AI models go far beyond these standard metrics. They incorporate alternative datasets, such as economic indicators, interest rates, inflation rates, sector performance, and even geopolitical events. By analyzing all of this information together, AI models can detect patterns and correlations that humans might miss, allowing them to provide a more nuanced and precise estimate of a stock's intrinsic value. Machine learning is at the core of most AI valuation models. Supervised learning techniques, such as regression analysis, random forests, and support vector machines, are trained on historical stock and market data to understand how different factors influence stock value. These models learn from past market behavior and can then apply that knowledge to predict a stock's potential future value. For example, a supervised learning model might recognize that companies with consistently growing free cash flow and low debt-to-equity ratios tend to outperform in the long term. By recognizing these patterns, the model can flag undervalued stocks that meet similar criteria, giving investors a data-driven perspective on potential opportunities. Deep learning takes AI valuation to the next level. Neural networks, particularly deep neural networks, can analyze nonlinear relationships and complex interactions between multiple variables simultaneously. In stock valuation, this means that AI can detect subtle patterns in financial data, market trends, and alternative data sources that traditional models cannot. For instance, a neural network might find that certain combinations of earnings growth, social media sentiment, and macroeconomic trends are strong indicators of a stock's future performance. Long short-term memory networks, or LSTMs, a type of deep learning model, are particularly effective because they can analyze sequential data over time, capturing trends and shifts that occur gradually in the market. Another critical tool in AI valuation models is reinforcement learning. Unlike supervised learning, which relies on historical labels, reinforcement learning enables AI to learn from its own actions and outcomes. In the context of stock valuation, reinforcement learning models can simulate trading scenarios, adjust their predictions based on feedback, and optimize strategies for maximizing long-term returns. Essentially, the AI system experiments, evaluates its performance, and continuously improves, much like a human trader learning from experience, but at a speed and scale far beyond human capability. AI valuation models also integrate alternative data to provide a more holistic view of a stock's true value. Alternative data includes news sentiment, analyst reports, earnings call transcripts, social media discussions, web search trends, and even unconventional data like satellite imagery, corporate supply chain activity, or foot traffic near retail locations. For example, if a retail company shows increasing foot traffic in key stores combined with a spike in positive social media sentiment, an AI model may interpret this as a bullish signal that the stock is undervalued relative to its future revenue potential. By combining structured financial data with unstructured alternative data, AI provides a more comprehensive valuation than traditional methods alone. One of the most valuable applications of AI valuation models is identifying undervalued or overvalued stocks. By calculating a stock's intrinsic value and comparing it to its current market price, AI can highlight investment opportunities that might be missed by manual analysis. Fourth, Example, a stock trading below its AI-determined intrinsic value may be considered undervalued and a potential buy opportunity, while a stock trading above its intrinsic value may be overvalued and potentially risky. For investors, this kind of analysis can inform buy, sell, or hold decisions with a higher degree of confidence and less reliance on guesswork or emotion. Risk management is also integrated into AI valuation models. Predicting a stock's intrinsic value is not enough if you don't consider market volatility, company-specific risks, or sector-wide downturns. Many AI systems evaluate risk by analyzing historical volatility, liquidity, macroeconomic factors, and potential negative sentiment from news and social media. This allows investors to understand the potential downside of an investment and balance their portfolio accordingly. By combining valuation with risk assessment, AI models provide a more complete toolset for making informed investment decisions. While AI valuation models are powerful, it's important for investors to recognize their limitations. AI is only as good as the data it analyzes, and poor quality or incomplete data can lead to inaccurate predictions. Unexpected events like geopolitical crises, sudden regulatory changes, or natural disasters can create market conditions that no model can fully anticipate. Therefore, AI valuation should not replace human judgment entirely. Instead, it should be used as a complement to traditional fundamental analysis, market research, and disciplined investment strategies. For beginners, getting started with AI valuation models has never been easier. Many AI-powered platforms now provide easy-to-use interfaces where investors can analyze stocks, calculate intrinsic value, and visualize predictions without needing advanced programming skills. Retail investors can start with smaller portfolios, experiment with different models, and gradually gain experience interpreting AI insights. Over time, more advanced users can customize models, incorporate additional data sources, and refine their investment strategies based on AI predictions. The impact of AI valuation models on the U.S. stock market is significant. Hedge funds, institutional investors, and high-frequency trading firms have been using AI for years to gain an edge in stock selection, portfolio management, and trading efficiency. Today, retail investors can access similar tools, leveling the playing field and allowing more people to make data-driven decisions. As AI continues to evolve, these models will become faster, more accurate, and more adaptive, integrating real-time market data, global economic indicators, and alternative data streams to provide investors with the clearest picture of a stock's true value. In conclusion, AI valuation models are changing the way investors approach stock analysis. By combining machine learning, deep learning, reinforcement learning, and alternative data, AI provides a sophisticated, data-driven approach to determining a stock's intrinsic value. For beginners, starting with AI-powered platforms and gradually exploring more advanced models can provide practical insights and improve investment decisions. Experienced investors can leverage these models to optimize portfolios, identify undervalued opportunities, and manage risk effectively. If you found this video helpful, make sure to subscribe to our channel for more insights on AI and investing, stock market analysis, and personal finance strategies. Like this video to help others discover the power of AI valuation models. Leave a comment with your thoughts or questions, and share it with friends or family interested in smarter, data-driven investing. By understanding and using AI valuation models, you can identify profitable opportunities, make informed decisions, and gain an edge in today's competitive financial markets.